is one of the fastest growing retailers, online retailers in the world, because they use AI to make very specific products to meet demand. But there's a change in the rules on tariffs and customs duties that has a big impact on Shein's break-even level. So what is Shein? Well, here's the website. Shein is one of the biggest online direct-to-consumer retailers, in large part because they use AI to very specifically target what consumers want, design it, get it out at low prices very quickly. So they produce thousands and thousands of items in a very small quantity to meet customer demand. So that's what they do. So you can see on the website, if I scroll down, there's dozens and dozens and dozens of categories and stuff. But there's a big change that's happening related to Shein's costs. So if I go over to Forbes magazine, the headline here is Trump reinstates de minimis tariff exemption for shipments under $800, boosting Shein, which we're talking about, and Temu, which is another one of these online direct-to-consumer retailers. What had happened is that there was an exemption where if you ship something from overseas, which Shein does, and it was under $800, that cost was removed because it was kind of de minimis or too small to be charged. Then the Trump administration switched and charged it, which had a huge impact on Shein's ability to send goods cheaply to other countries, including the US. And so now what has happened as I record this video on February 25th, Trump has reinstated the tariff exemption, meaning that these orders will not be charged the customs duties tariffs on these relatively small orders. This is a great opportunity to talk about break-even costs as it relates to this issue. So how did this Shein tariff costs affect the overall cost of doing business for Shein and also profitability? Well, let's talk about the break-even formula, which is a great starting point to think about this. And in fact, if you're a small business owner, you can do these sort of calculations in the back of a napkin. So your profit is your sale price less units sold, less variable cost times units sold, less fixed cost, which is fixed in dollars. So this is an old example that I have about Hershey making Reese's candy. Sale price, variable cost, fixed cost is a fixed dollar amount, and I'm going to assume 2 million units sold, okay? So if we multiply, we get total sales using the sale price in blue, total variable costs using variable costs at $3. Fixed cost is fixed. Nothing changes, and we end up calculating our target profit. So here's the point about Shein. If those tariffs, if those duties were charged, variable costs would be higher because you've got to pass that cost on to the consumer. So let's just say for kicks, I'm going to change this number to $3.20. What happens? Well, your profitability goes down because your variable costs are higher. That also has a couple of other impacts. So there's a term called margin of safety, which is the difference between your actual sales and break-even sales. So if Shein's sales vary, that's also a factor. So let me click on this number and show you what happens here. Let's assume that Shein expected 1,592,000 expected sales. They actually sell 2 million. Well, that's a good thing. They've got a margin of safety. They've got a difference between those two numbers of 408,000. Well, if the tariffs are higher and they have to raise the price of the product, they may not sell as many units, actual units. What does that mean? That means that the margin of safety, the difference between actual and break-even sales, is going to go down. So that's a factor. All of these factors are related, and I can play with any of these numbers and show you how they change the chart. If we change the sale price to $6, you can see the profit goes way up. If I change this down to $3.70, you can see we're operating at a loss. So the point here is that tariff or duty that Shein was going to be charged on orders has a big impact on the break-even formula, on profitability. And if actual sales went down because prices were higher, it would also impact margin of safety. A critical issue with accounting is that every single cost needs to be passed on as a product or service that you sell to someone. Every single cost. And if you're Shein and you have these tariff duties, that has to be included in the cost of your product. It raises your variable cost, and it will reduce your profitability if you don't raise your price. And all these factors are connected with the break-even formula.